understanding the recent market decline, I think is really, really important because many people, I guess, over the last week or so, they came to me and said, Ali, you know what? I'm really fearful. I'm actually thinking about selling out my investments. The world is in turmoil right now, and it's really spooking me. And perhaps it's time to sell. And I had this conversation with a couple individuals recently, and I said to them that I don't think it's about the world being in a bit of turmoil right now. I don't think the recent decline in the stock market has anything to do with geopolitical events, what's going on in the Middle East, or what's going on in Russia, Ukraine, or with China, or the US election. Uh, Really, what spooked the markets, I guess, last Friday, if we go back to last Friday, is this jobs data or jobs report out of the US. We were expecting about 180, 185,000 jobs created in the US. We ended up getting a much lower number. The United States created about 114,000 jobs. Not only that, they revised downward the previous month. So the month of June, down to below 200,000, down to about 179,000. And this really spooked the markets for some reason. Prior to that, whatever data came out, the market seemed to look past it. But this data in particular, I think, gave individual investors a reason to sell. It gave the computer programs a reason to sell. And that's what we saw last Friday. On Monday, while we were closed here in the Toronto Exchange in Canada, the US was open, and boy, were the markets in tough. The Dow Jones down over 1,000 points. Markets were down 3%, pretty much right across the board. Dow Jones maybe 2.5%. NASDAQ down well over 3%. S&P 500 down 2-3% as well. So this is what happened. It was all about this idea that, well, maybe things aren't as good as the Fed thinks they are, and perhaps the Fed should have already cut rates. Talk was so the talk was so fearful that I heard some people saying maybe they should have an emergency cut. They should cut rates before their next meeting. They shouldn't wait to their next meeting. I even heard someone say they should cut 75 points as an emergency cut before the September meeting. So to me, this is just fearful talk. We really didn't see that bad data. We still saw jobs growth in the US. 115,000 jobs were created. It wasn't like we saw negative jobs growth. So I just don't understand why we went from a situation where we're still fighting inflation, that inflation is the number one issue and the number one problem that as investors, as an economy, the US has to fight, to fearing a recession, fearing a huge downturn in the market, one that we would have to see a big cut, and perhaps even an unexpected cut nonetheless. So to me, I think the drop in markets was overdone, of course, to the downside. I don't believe the U.S. economy is in as bad shape as we've seen over the last year or so, last few years. Yes, the U.S. economy is slowing down, but is definitely not in anywhere near a recession. First chart we have for you today is one that really shows us the S&P 500. S&P 500, I believe it's a monthly chart. We can show it here. There it is. And you can see really how big and how steep the decline has been. And not only has it just been earlier this week and end of last week, but the S&P 500 has been falling for, I guess, a few weeks now on the back of this idea that maybe things are slowing quicker than the Fed really believes. Second chart we have for you here is the NASDAQ. Again, a 1-month chart, and you could see that the fall in the markets is definitely based on, or at least led by, the tech stocks. Obviously, the tech stocks make up most of the NASDAQ. There are a lot of other stocks that are trading there as well, but the tech stocks make up most of the NASDAQ, and you can see how much the NASDAQ has fallen. It actually got into what we call correction territory, meaning down by more than 10% from the high. But what I tell clients when they ask me, how bad is it? Should I be concerned? Should I be worried? How much have I lost? I think the next couple of charts really show this. Let's show the S&P 500 on a 1-year basis. And what I want to tell all of you watching today is, think about it. The amount of loss that perhaps individual investors, perhaps all of you have faced or have experienced in the last couple of weeks, that wasn't really loss. When you look and see how much your portfolios or how much the stock market has gone up in the last year and a half, you've given back some of the gains. That's really all you've done on the S&P 500. You can see here, the market, the S&P has come down, the chart has come down, but nowhere near where it was a year or two ago. If we take a look at the NASDAQ, let's put that 1 year chart up, you'll see the same thing. We've just given back some of the gains. And as we now know, of course, Tuesday was a great day. We made back a big chunk of what we lost on Monday. So everybody, or at least many investors, were saying, let's buy that dip, let's get back in, because investments have gotten way too cheap, way too oversold. And to me, that made sense. And I was a buyer at that point as well, buying for individual investors of mine. And it just made sense that overall, this market wouldn't stay down for too long. And not to say that everything's going to come right back up. Obviously, we might see the markets kind of go sideways for a little while. But overall, I still maintain that we will be higher at the end of the year than we are today, even with the recent decline that we've just noticed. The next chart that we have here just shows you how fearful people were. The VIX here, the volatility index, you can see here, the volatility index is an index that shows basically, it measures fear in the markets. You can see spikes that have come on during COVID, during the financial crisis. And you can see that the recent spike in the VIX, we haven't seen a time like this since the pandemic. We actually saw the VIX reach 65. Just a week ago, or maybe a week and a half ago, it was like 15. All of a sudden, everyone becomes fearful, the market sells off, and the VIX spikes well beyond where it should have. And in my opinion, I think this just goes to show you that how much fear there was in the market. And usually when we see the VIX spike like this, it's a contrary indicator. When we see a spike in the fear and the volatility, that usually is a time to buy. And those that buy at that time usually do well in the coming months and quarters and even years to come. So keep that in mind as, I guess, a contrarian index or a contrarian gauge as to how the markets are doing. So for me, looking back, I think that the markets, yes, they dipped unexpectedly. It's never expected. And because of that, there was this fear that came on. There were people that were questioning, individual investors were questioning the markets. I maintain that these corrections happen. They happen a few times every year. It is healthy. Understand these corrections will happen, especially when we reach all-time highs so quickly. And I think you have to embrace the correction and use it as an opportunity. Use it as an opportunity to buy the investments that you always wanted to buy, but they were just too darn expensive. Now they are a lot cheaper. So to me, yeah, once you understand why the market went down and understand that it was because of fear that the US economy is slowing down quicker than the Fed is basically saying, that is really what we saw earlier this week. And in my opinion, a lot, it was a lot overblown. I think it never should have fallen as much as it did.